Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to forward contract as a cash flow hedge. We're going to be entering transactions and doing calculations related to a forward contract used as a cash flow hedge. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have the information on the left-hand side. We're going to enter that into the blue area on the right-hand side, including our journal entry and our trial balance worksheets for year 1 and year 2. Let's take a look at our data. The data will be similar to prior presentations that we will have, but we're obviously concentrating in on those areas that differ. So we have 12-1X1 U.S. company, that's us, the U.S. company, entered into a 120-day forward contract to purchase Australian dollars. We've seen that in prior example problems. That's going to be the part that's the same. We have the spot rate and forward rates. We'll get back to them shortly. Then the forward contract was a hedge to anticipate purchase of furniture on January 30th, 2000X2. The purchase took place on January 30th, 2000X2 with payment due on 331X2. So I'm going to recap that shortly, but then we have the items that are different here. The derivative is designed as a cash flow hedge. So it's a hedge, it's a cash flow hedge. Company uses the forward exchange rate to measure hedge effectiveness. Okay, so scenario then being that we, the U.S. company, as of December 1st, 2000X1, have gotten into an agreement, basically to an anticipated purchase agreement to purchase furniture from an Australian company, and we expect the purchase to take place on January 30th, 2000X2. But the purchase will be done on account at that point in time. So that's when we're going to actually record the depreciable asset, the furniture on our books, but we're not going to pay it. We'll also record a payable at that point until March 31st, 2000X2. And so we took out then a forward contract for 120 days, 120 days being 4 months, basically, from the point in time and that means it's going to be from the point in time that we made basically the agreement to make the purchase in the future, as of December 3rd, as of December 1st in this case, until the actual payment that took place in March. So notice we're kind of covering two different things, because as of December, then we haven't really got the furniture yet, right? We've kind of made this tentative agreement we've made this agreement to purchase the furniture on January. So from the hedge being from December to January 30th, the time that we actually put the payable on the books, is like kind of a different type of situation than, of course, the situation that we've seen in the past, where we have the accounts payable and we can have the forward contract to help us out with the change in rates on the accounts payable from the point in time it goes on the books to the point in time that we pay off the payable. Now, again, we're saying here that the derivative is designated as a cash flow hedge. Okay, so let's see how this would go. We're going to say on 12-1X1, we have not yet purchased the furniture, but we made this agreement to do so, and we wanted to basically put this forward contract in place at that point in time. So we're going to put the forward contract in place, which basically means we're going to have a receivable and payable on the books, right? So we're going to say we have this forward currency receivable, and that's going to be in Australian dollars. So we expect to receive, Australian dollars in the future. And then we've got the payable on the books, but that's going to be in US dollars that we're going to pay in the future. So we're going to be paying US dollars in the future and we're going to be receiving these Australian dollars. All right. So then we're going to say that the amount is going to be equal to 100,000, because that's the amount that we expect to pay at the end of this whole thing when we actually pay off the payable on 331. 100,000 times the future rate, or the forward rate, because this is the rate that we expect to be the case at that point in time. So we're predicting the predicted rate. So there we have the debit and credit. Let's record that out. We got the foreign currency. We're going to be debiting the receivable. And then the credit on the books is the cash that we're going to owe, just straight US dollars in the future. Okay, so then we're going to say at the end, now we didn't record the furniture because we're not going to get it till basically, we're not even going to put the payable or the furniture on the books until next year in January 30th. But at the end of the year, we're going to have to revalue this thing. So we're going to say 12-31X1. Now we've got this receivable on the books that is going to, change in value. The predicted future value has now changed. It's on the books at the 60,900. And we're going to say, well, now it's 100,000 times the 0.612, this forward rate right here. And that's going to be the 61.2. If I subtract minus the 60900, we've got a $300 difference. And that $300 difference would basically be income or gain, right? So and why would that be? Because we had one Australian dollar would have been predicted to be $0.609, and now one Australian dollar is predicted to be $0.612. Therefore, the Australian dollar has increased in value. The Australian dollar went up, and we're going to be receiving Australian dollars because it's a receivable. So we're going to be getting something that's now has more purchasing power. So it's an increase. So we're going to say, all right, then that means the receivable is going to go up. And then the other side, this is kind of like the different thing we're going to put into the other comprehensive income. We're not putting it into the gain here. We're putting it into other comprehensive income. So that's going to be the new kind of thing that we're going to reflect it in. So we're going to say, all right, I'm going to calculate that again. I'm going to say this is going to be equal to the 100,000. We're going to say times brackets. We're going to be picking up the larger of the two numbers. I'll pick up the 0.612 minus the smaller of the 2.609. And there we have the $300 on the debit and credit. So we have the foreign currency receivable then. Let's go into that, double clicking on it, go into the end of it, plus picking up the $300. We have the other comprehensive income then here, other comprehensive income, $300. All right, moving forward, we're going to say now it's going to go into year 2. So in year 2, we will say that we now have our ending numbers here for year 1 are now our beginning numbers for year 2, just to roll us forward. We're only obviously recording activity related to what we're focusing in on here. So, and that's going to be our beginning numbers. Nothing's in the net income. At this point in time, it's been rolled out into the retained earnings. Okay, so then, and notice we did roll in the other comprehensive income just here, so we can push forward on the next time period. Okay, so then we have then the January 1st January 30th, X2. This is when the actual purchase is taking place. So we got to put the purchase on the books, but we're going to do the same thing and revalue the receivable first. So let's go ahead and revalue the receivable because that's the same routine we saw in a prior problem. It's currently on the books at the 61,200. So let's say then we're going to take that 100,000 times. Now we're saying the new rate is going to be times 0.605. And that's going to be the 60,500. This minus the 61,200 is a $700 difference. That $700 difference is going to be then a loss in essence, and we're going to record that in other comprehensive income as we did in the past. Well, so we'll use the same other comprehensive income account. Why is it a loss? Because it went from one Australian dollar being worth 0.612 to US dollars to one Australian dollar being worth 0.605. So that means the Australian dollar compared to the US dollar has gotten weaker, and we're going to get paid in Australian dollars, so that means it would be a loss. Now, we're going to record it in other comprehensive income using the same account here. It's going to be a debit, so kind of like a loss would. So again, we're not using the loss, we're putting it into the other comprehensive income. The other side then going to the foreign currency receivable, and then we'll do that same calculation here. This equals, and we're going to say this is going to be brackets, and we're going to pick up the larger number of the two that we will be using, minus the smaller number, close up the brackets, multiply that times the 100,000. Times the 100,000, there's the 700 debit and credit. Let's record it out then. We're going to be down here in the other comprehensive income, where we will say there is our debit in the other comprehensive income, and then the credit going to the receivable. So the credit going then to the receivable. All right, now let's put the asset on the books as of 1/30 X2. Now we're not paying for it yet, but we're going to put the asset and the liability on the books. So here's the depreciable asset. Then we have the liability, which is going to be the accounts payable, which we will be paying in Australian dollars. We're going to put that just simply on the books at the spot rate at this point in time. So we're just going to say, so notice we're not dealing with basically capitalizing the changes in the value. So as we've seen in a prior problem, we're just going to say, all right, at this point in time, it's 100,000 times the spot rate, what it's currently at, not predicting the future. We're just going to take that spot rate, 0.608. That's what we're going to record the depreciable asset on the books for, and then we'll have the liability as the same amount. So we're going to say the depreciable asset then on the books at that 60,800. Then we have the accounts payable that's going to go on the books at the 60,800. Okay, so then on 331 x2, we're going to have to make the payment. So 331 x2, now we're paying off the payable in the future. We got our receivable to deal with, and we've got the payable that we're going to have to basically deal with. So let's think about the receivable. We've been working with that one. We've got the 60,500. The 60,500 currently there. We're going to say, all right, now it's at 100,000 times, and we're at the 331, right? So now we just need the spot rate. There is no forward rate because we're at this point in time. So the 100,000 times the 0.602 is going to be the 60,200 minus the 60,500. That's going to be the $300 difference. So we have a $300 difference basically being a loss. Why? Because we had the 0.61 Australian dollar being worth 0.605 US dollars. Now 1 Australian dollar is worth fewer, or 0.602 US dollars. The Australian dollar then got weaker. We're getting paid in that weaker currency. So therefore, we basically have a loss that happens. So we're going to be putting that loss, a debit, but we're going to put it into this other comprehensive income account using the same account we've been working with. The other side then going to the foreign currency receivable to revalue that. So there we have that. Let's go ahead and calculate it again. This is going to be equal to, we will then be picking up the 0.602 minus the 0.605, close up the brackets, multiplying that times the 100,000. Times the 100,000. And then I'm going to have to flip the sign because I picked the larger number minus the smaller. I'll just flip the sign. 300 debit, 300 credit. So we're going to record this out to the other comprehensive income. Something's in it, so I'm going to say F2 plus F2. We'll pick up that $300. Then we've got the foreign currency receivable. Foreign currency receivable, something's in it, so I'm going to say F2 plus F2. We'll pick up that $300 credit. Okay, so now we're going to be thinking about then the accounts receivable, revaluing in essence the receivable. This is on 331x2. I'm just going to say equals this one. So now we have our, and this is our payable. We're thinking about our payable now. It's on the books at 60,800. And once again, we should have it at the 100,000 at the current time period, which is 0.602, 0.602. So we need it at 60,200 minus the 60,800. That's going to give us our $600 difference. And that $600 difference here is going to be a gain. Why? Because it was at $1 compared to the 0.608, or sorry, 1 Australian dollar was worth 0.608. Now 1 Australian dollar is only worth 0.602. The Australian dollar got weaker, but in this case we're paying in Australian dollars. So now we're making a payment in something that went down in value, which is good for us. So that is going to be good. So we have a gain there. So now we're going to say that we have the accounts payable. It's going to go down from a U.S. currency perspective when we pay the Australian dollars. And then the other side, we're going to be recording this time to a gain. It's not going to the it's not going to the other comprehensive income. We're simply recording a gain because we're not talking about the forward contract. We're talking about the account, the difference in the accounts payable here. So then we're going to be saying, recalculating this is going to be brackets. Let's take the bigger number minus the smaller number this time, coming out with a positive or debit amount. and then multiply that times the 100,000. And there we have our 600 debit and credit. Let's post that out. So we're going to go to the payable, double clicking the payable, plus we'll pick up that $600, brings the payable to that 60,200 that we had calculated. And then we have the gain down below. The gain's going to be here. This will be equal to that 600. So there we have that. So now we're basically going to cancel out that gain now. We're going to move, in essence, the gain to the other comprehensive income so that it's showing here as a gain, and then we're going to be moving it to the other comprehensive income. So let's take a look at that now. What would that look like? We're going to say then that we have the loss. So we're going to record a reflecting loss that will be equal and opposite to it. The other side going to the other comprehensive income. It's going to be for that $600 on the debit and the credit. So recording this out, we've got the loss then. So the loss is going to be removing that so we can see that, basically mirroring each other. And then other comprehensive income reflecting it. So if I double click on other comprehensive income, we'll pick up that $600 credit there. Now we'll pay off the exchange broker. So we're going to say, all right, now let's pay off the exchange broker. We have this amount that's going to be payable, $60,900 that's due there. We're going to just pay that with cash. So that's straightforward. Cash is going to be going down. I'll put that on the bottom, and we're just going to pay that off. No need to adjust any currency adjustments where that amount is due. It's a payable due in US dollars. So we're going to be picking that up. That's the $60,900. So I'm just going to say negative of that amount. This amount has not changed since we first put it on the books up top. So we first put it on the books up here, and now we owe it back. All right. So we're going to say then we have the dollars here. This is the forward contract that we put on the books. So that's going to be the debit, making it go to 0. Then we'll record the cash. Cash is going to be up top. We're going to record the cash. Will then be the credit. Okay, then we're gonna be dealing with the foreign currency units that we expect to receive. We're gonna get foreign currency units from this receivable. So we have the $60,200 representing cash, but we're gonna get paid in Australian dollars, and we're gonna get paid 100,000 of them, which we have adjusted that amount to be reflecting the current value in US dollars of the 60,200. So we're gonna say, all right. Now we're going to get foreign currency units here. So we're actually going to get 100,000 Australian dollars, but we're going to reflect them in the US equivalent value. And that's going to be equal. We can calculate this again. It's going to be equal to this 100,000 times the current spot rate. So that's that 60,200. That's going to be the debit and the credit. And we'll pick up then, we're going to be reducing the foreign currency receivable. Recording this out, we have the foreign currency in units. Foreign currency units up top. Increasing that amount, and then we've got the foreign currency receivable here. And I'll double click on that, go to the end of it, say plus, and we'll pick up that 60,200, bringing it back down to 0. So next we have the accounts payable that we're going to pay off. So here's the accounts payable we're going to pay off. We have it reflected in dollars, but we're going to be paying it in the Australian dollars, which is that 100,000. So this amount is reflecting the fact that we owe Australian dollars, but it's reflected on US dollar terms. And then we have currency up here reflected in the US value, but reflecting how much that we're actually holding on to Australian currency, which is the $100,000. 100,000 Australian dollars. Okay, so let's record this. We're going to say then that we're going to be paying off the accounts payable, and we're going to be paying it with the foreign currency, which is the Australian dollars that we have. And then we're going to say we can calculate this again, same calculation. We're going to say this is equal to the 100,000 times the spot rate. That's how much we have, and we're going to be paying the actual 100,000 of Australian dollars, and we're going to record this. Here's the payable, double clicking the payable, going to the end of it, saying plus. We'll pick up that 60,200. That brings it to 0. Then we've got the foreign currency units, double clicking on it, going to the end of it, plus that 60,200, bringing it to 0. So we have cash on the books, the 39,100. The foreign currency units have now been used to pay off pay off the liability. We got the foreign currency receivable is now down to zero. It has been received. Depreciable asset on the books at $60,800. That reflecting the depreciable asset price, using the exchange rate basically that happened when we actually assumed the purchase to take place. So that was on January 30th. Then we have the accounts payable is back down to zero. We have the dollar payable to the exchange broker for the forward contract down to zero. No firm commitment used in this session. Then we've got the foreign currency transaction gain and loss canceling each other out and basically being reflected then in the other comprehensive in the current year, year 2, and it being reflected in other comprehensive in year 1 as well.